So welcome, and here we are to talk about rebalancing. What rebalancing is pretty simple. You have you're in a portfolio. You have a certain goal for the amount of money that's in stocks and bonds, and different funds that are in there. And then over time, some of those funds go up more than others, or some go up while others go down. And then when you rebalance to get it back to the original intent, then you end up, sorry about that, I was on the wrong slide. You end up getting a little bit of a benefit, and you'll see it actually can be a pretty significant benefit. So if you've seen our other recording that's at the same location, that's helpful because you'll see that the assumptions I'm making for our little made up example here are right spot on. It's very normal for markets to be up most years. It's also very normal for there to be an intra-year decline. And we showed that in the other presentation. So what we have here is we're assuming it's the year 2020, actually recording this in March 2020 when the market's been impacted by coronavirus. And we have a very simple portfolio. This was just made up here, okay? So $40,000 total, $20,000 in stock, $20,000 in bonds, relatively conservative portfolio. So think of this as maybe someone in retirement. If they are in retirement, by the way, hopefully they also have some cash reserves because you don't want to be stuck taking money out of your retirement portfolio when the market is down. So all of a sudden in early 2020, a virus hits. At first, it seems like a remote thing that's impacting other countries. Now it starts impacting the USA. And by the end of February, stocks have dropped by 10%. And then they drop another 20% relative to the beginning of the year, or 22% relative to the end of February. And bonds rise slightly during that time, by the way. And I'll show you the details in a second. And by the end of the year, stocks are up 10% and bonds no change. So let's look at three different scenarios of rebalancing. In the first case, no rebalance. For whatever reason, one advisor never quite acted. Maybe they almost pulled the trigger, and then the stocks started coming back up. They decided not to do anything. Or maybe this was not an advisor, but someone else who wasn't doing rebalancing. And then in the second scenario, an advisor saw that after they quickly dropped 10% on stocks, he decided, boom, he or she decided, boom, we're going to do that and do the rebalance. But then when they saw the stocks dropping more, they thought, okay, I'm going to rebalance again. And in the one perfect rebalance, one advisor, she got very lucky. And then acted right when stocks were at the very lowest time of the year at minus 10%, did one perfect rebalance, perfect in that the timing was perfect and very lucky. Okay, not that you can't be close to that. You can certainly be in and around that because you do see the market going down. So this is what the graph we're looking at here, the chart. We're starting with the 40,000 total dollars here. We're not separately showing the bonds and stocks. We're just showing the total value. Here we have the stocks go down by 10% and the bonds go up by 5%. Well, let me show that to you in a second. Over here, by the way, just see the colors. The blue is no rebalances. The red is two rebalances, and the kind of gold color is one perfect rebalance. And here they are shown here. Okay, now here's that first inflection point where the stocks go down 10%, bonds go up 5%. And the advisor doing two rebalances says, that's enough of a change for me. I'm going to go ahead and do a rebalance. Why not? And smart move. And so then in the second phase here, that was at the end of February. At the end of March, the stocks go down by another 20% compared to the first of the year, or 22% compared to the previous point here. And the bonds stay flat, though, from what they were here. They're still up 5% for the year, but they don't. What happens is that the market's so turbulent here at this point that bonds can only go up so much when people are doing all these rebalances. So let's say the bonds stay flat there. And that's kind of similar to what happened, by the way, with the coronavirus. So at this point, this lowest point in the year for stocks, the second rebalance occurs for the person doing two. And then the one perfect rebalance is done for that lucky advisor that got the timing exactly right. Okay. So now we go here, and now we have the results. So the no rebalance is the blue line here, and that represents 5% up. That makes sense because the stocks at the end of the year, the stocks were up 10% across the whole year, and bonds were flat. And since the stocks are one half of the portfolio, one half of 10% is 5%. So the whole portfolio is up 5%. And in the case of the 2 rebalances, the portfolio is up 9.4%. Wow, that's awesome. I mean, that was not that much work. We just did 2 rebalances. Didn't require a degree in physics to do that. And we had we got a great return. I mean, if we'd been in 100% stocks, by the way, you would have had a 10% increase. So by doing 2 rebalances in a very conservative portfolio, you almost got as much of a return as somebody that was in 100% stocks, just a tad below. And by the way, if you got that one perfect rebalance right at the bottom there, then you actually beat a 100% stock portfolio and you got a 10.4% return. So the power of rebalancing is awesome. We do it all the time. Whenever there's money going in and out of the account, we look at the rebalance and see, okay, can we do a little bit of a rebalance just by moving money in or out? For example, if we're moving money in, we want to put it in the fund that is currently is the farthest out of whack below its stated percentage, because then you're buying low. And if, let's say, you're in retirement, you're taking money out, then you want to take it out of the fund or the asset class that's the highest relative to all the other items in the portfolio, so that you again are accomplishing at least a partial rebalance by taking money out. And by doing that, by the way, you're buying low and selling high. So the rebalancing is a great way to think about it, because for the average human being, if you have a stock or a fund that's going up, 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 it's very hard to sell that, because you're thinking, wait a minute, it could go higher. And if something's really low and going down, and then someone says, well, buy more of that, and you're thinking, why would I buy that? It's going down like a rock. But guess what? It's going to come back up. So it's actually a good thing. And the rebalancing forces you to do something that would be hard to do just by looking at that individual fund alone. So that's rebalancing. We're very proud to do that very effectively for our clients, to help them get some more return out of their investments and have a less risky portfolio, because we're putting things out of a high risk and putting them into a lower risk. And by the way, that's one other thing I want to say while I still got you on the line. When stocks drop a whole bunch, they're actually less risky, not more risky. When stocks have been pumped up, that means they have room to fall down. So there's actually more risk there. So by buying stocks when the market is in the dumps, that's a very smart thing, because those stocks now are at a lower risk than they were when they were higher. I know that's sometimes a hard concept to understand, but it's important to think about. Not shown as our email. It's a roadmap@o'reillywa.com. That's roadmap@o'reillywa.com. Contact us if you have any questions. And I'll be turning this presentation off, or this recording off, momentarily. So have a great day, and we will talk to you later. Bye-bye.